Welcome to today's market report.
European stocks slipped on Friday as US employment data pointed towards slowing growth in the world's largest economy, with retail and travel stocks exposed to American markets suffering the most. The Pan-European Stoxx 600 index slipped 0.6%, marking its worst fall in 2 weeks after data showed the US economy created the fewest jobs in 7 months in August. Global equities also tumbled after the data. Retail stocks were among the worst performers for the day, dropping 0.9%. Bookseller WH Smith, which makes at least a quarter of its earnings from US customers, was the worst performer in the sector, down 3.4%. Travel stocks sank 1%. The laggard US data was attributed to a rise in the highly contagious Delta variant of the coronavirus, but analysts saw a bright side in the reading, specifically that weakness in the job market would give less impetus to the Federal Reserve to rein in liquidity measures. Friday's weaker than expected jobs put less pressure on the Fed to taper its stimulus, which is likely to provide a short-term boost for stocks. The stock market loves stimulus, and any indication that the Fed will remain fully accommodative is good news for investors. According to Zega Financial, European technology stocks were the best performers of the week, up nearly 2% as investors fled to sectors most resilient to disruptions caused by the pandemic. A private survey also showed activity in China's services sector contracted sharply in August as restrictions to curb the COVID-19 Delta variant threatened to derail the recovery. But Eurozone business activity remained strong last month. IHS Markit survey showed suggesting the bloc's economy could be back to pre-COVID-19 levels by year-end, despite fears about the Delta variant of the coronavirus and the widespread supply chain issue. The European Central Bank will meet next week amid calls from several hawkish members to slow down its pandemic-era purchases program. A Reuters poll sees the bank announcing a cut to its asset purchases, given a recent spike in inflation. Payments company Nexus slipped 0.8% after Italy's competition watchdog said it had opened an investigation into the company's planned merger with domestic rival SIA. Spanish fund distribution firm Allfunds jumped 11.7% and was the best performer on the Stoxx 600 after its maiden first half results beat expectations. German exchange operator Deutsche Börse is expected to announce new entrants to the blue chip DAX index on Friday, part of the index's biggest ever overhaul. On the FX front, the GBP USD printed a fresh 2-week high during the American session at 138.74. It remains near the top, holding on to most of its daily and weekly gains on the back of a weaker US dollar across the board. The US employment numbers triggered a decline of the greenback, adding to weekly losses. The numbers showed hiring slowed in August to 235k, below the 750k expected. The unemployment rate dropped to 5.2% and wages rose 0.6%. Wages continue to push higher as a result, but the dampened pace of hiring and bevy of workers still on the sidelines will keep the Fed awaiting more progress on the labour market. Today's report fully closed the door on the chance of a September taper announcement, in our view, according to Wells Fargo. The decline of the dollar took place even at US yields head higher. The US 10-year rose from 1.27% to 1.33%. The dollar index is off lows at 92.07, down 0.15%. The euro dollar this week edged up to levels not seen since late July. According to Rabobank, the US August labor report provided additional support, though some of it was short-lived. The dovish tapering message from Jackson Hole, combined with the softer than expected August payrolls report, will have provided some relief to EM investors. That said, in the view of Rabobanks, a strong surge in confidence in EM market is necessary to provide the grounding for a significantly weaker US dollar. Assuming the Fed continues to edge towards tapering and talk of an eventual hike in the Fed funds rate is not totally blown off course, we retain our 1-month Eurodollar 118 forecast, 80 pips off the current level.
This is today's market news. Thanks for listening. We'll see you next time.